Everyone literally wrote this company off. But if you look closely, they are quietly building a massive financial moats. Let's jump right into this explainer today, because what we're looking at is Opendoor pulling off a radical pivot. They're transforming from a heavy, capital-intensive property manager into this slick, asset-light, AI-powered financial ecosystem. It's actually wild.
So is Opendoor really just a distressed home flipper? I mean, that's definitely the prevailing market misconception right now. Just think back to 2022 for a second. Mortgage rates doubled basically overnight. Homebuyers completely vanished, and Opendoor was just left holding billions in depreciating houses. Their stock crashed by, roughly 99%? The market looked at them and just saw a distressed flipper. It's honestly a lot like how people viewed Carvana as just some doomed used car lot before its massive comeback. The whole consensus was that Opendoor's model only worked if home prices literally always went up to bail out their pricing errors. But here's the thing, that assumption, it's anchored to a version of the company that doesn't even exist anymore.
Just look at the stark contrast between that fragile legacy model and what CEO Kaz Najian is calling Opendoor 2.0. The old Opendoor, it took them a decade of really slow expansion just to reach about 50 markets, and they were carrying incredibly heavy balance sheet debt to do it. Now compare that to the new model. They hit nationwide coverage across over 380 markets in literally 10 weeks, all thanks to their new AI pricing engine. 10 weeks! And they're pulling this off with way less capital risk. They've got this cash now, more later program, which already makes up 35% of their weekly volume, by the way. It basically gives sellers flexibility while putting way less of Opendoor's own cash on the line. They've tightened up their buy box, streamlined operations, and totally cleaned up that balance sheet.
Now, to really grasp how powerful this new moat is, we have to talk about the elephant in the room, that roughly 6% national mortgage rate. For traditional iBuyers, that number is basically a brick wall. It just crushes buyer demand and affordability. When rates sit up there, the entire housing market just freezes. But, and this is the genius part, Opendoor actually figured out how to weaponize this exact macroeconomic headwind and use it against their competition. Enter Opendoor's newly launched 4.99% mortgage product. This is a brilliant Trojan horse strategy, guys. How are they doing it? Well, they're stripping out the 65 to 85 basis points of yield that traditionally gets sucked up by middlemen. By using automation and totally closing the loop on the integration, they can offer a rate a full percentage point below the market. Suddenly, they aren't just out there trying to sell a house, they are selling affordable financing. And no traditional rival can easily replicate that. No way. Okay, I absolutely love this next detail, because it tells you everything you need to know about the dramatic shift in company culture and agility under this new leadership. Think about the legacy financial sector for a second. If a traditional bank wants to develop and roll out a fully compliant, nationwide mortgage product, we're talking massive teams, tens of millions of dollars, and years, literally years, of red tape. Opendoor, they built this with 4 engineers in under 10 weeks. Let that sink in. That kind of velocity is a massive signal to the market about what this tech team can execute now that they are leaning heavily into artificial intelligence to run their operations.
And this brings us right to their broader strategy, which is essentially building a highly profitable second business inside the first. Getting a buyer in the door with that sweet 4.99% mortgage, that is just step one. They don't stop there. Think of it like building blocks stacking up. By vertically integrating title insurance as step 2, and then bringing in home warranties as step 3, Opendoor is capturing all those highly lucrative fees and services wrapped around the core real estate transaction. They are moving completely away from the old game of just flipping physical properties.
The financial impact of stacking these services is just massive. If you look at the unit economics here, the origination fees and servicing rights absolutely dwarf the old business model. The traditional spread you make on just buying and selling a house, it's small, it's highly volatile, and you're totally at the mercy of housing price fluctuations. But origination and servicing fees, structurally, they are vastly superior. They're asset light, they've got way higher margins, and they give Opendoor this recurring revenue stream that flows in whether that physical house goes up or down in value. It's a total game changer.
So bringing it all together, this creates what we can call the ultimate acquisition engine, the zero-cost seller flywheel. Anyone in real estate will tell you that customer acquisition is notoriously the hardest, most expensive part of the business. But think about how this flywheel turns. A buyer who secures that 4.99% mortgage today becomes fully integrated into the Opendoor platform. Fast forward a few years when they decide it's time to move again, they're already in the ecosystem. They essentially become a highly profitable future seller with literally zero marginal cost to acquire. Solving their financing problem today perfectly locks in tomorrow's housing inventory.
Now, Wall Street narratives usually lag way behind reality, but the unit economics are already validating this massive pivot. If you look at the projections from late 2025 into early 2026, gross margins expanded from 7.2% up to 10%. And honestly, more importantly, Q1 2026 delivered a contribution margin of 4.4%, which is the highest they've seen since mid-2024. Add in the fact that their aged inventory, those stale homes sitting on the market for over 120 days, that plummeted from 33% all the way down to just 10%. It is super clear they are generating real sustainable margins now. The company even announced that as of April 1st, 2026, they are adjusted EBITDA profitable on a 12-month go-forward basis.
All of this creates a truly fascinating market disconnect. Right now, analysts are pricing Opendoor with a price-to-sales ratio of 0.88x. They are treating them strictly as a distressed physical asset manager. But meanwhile, your average fintech platform, those trade anywhere between 3 to 5 times sales. The whole thesis of our explainer today is that the market is completely missing this transformation. As Opendoor scales up its mortgage attach rates and keeps layering on those title and warranty products, their revenue profile fundamentally shifts. They go from being a highly cyclical property trader to a data-driven, asset-light financial platform.
So, I'll leave you with this final thought to ponder as the real estate market continues to evolve. When does a home flipper officially become a fintech platform? Really think about it. If a company is using AI to price assets, underwriting below-market mortgages with a 4-person team in 10 weeks, and vertically integrating the entire financial stack of a transaction, all while generating positive contribution margins without needing home prices to just go up, well, maybe the old labels just don't apply anymore. Next time you're looking at the housing market, keep a really close eye on how these digital flywheels are quietly rewriting the rules of the game.